My biggest fear is that the unintended consequences of what they're doing that ultimately could lead to a bigger collapse. And I am calling for a long-term recession. So I think that we're going to get in a scenario where the economy does slip into recession. It probably won't be Great Depression-like. That's a horrible place to be.
Has the Fed really followed a path that you anticipated to this point? Did you think we were going to get this high? Did you think they were going to be this resolute in what they were thinking? How have you seen this situation develop?
So I do think that they followed the path that they should have followed. The question is are they not anticipating, or are they not looking forward enough at the future of what's going to ultimately happen, right? So basically you had a scenario where at first it was transitory, and we're talking inflation here. And then once it became apparent that it wasn't transitory, they reacted really quickly, and they jacked these rates up basically almost to 5% at this point on the Fed funds. And so then the question is are they now focusing on the negatives of inflation more than what could occur in the economy due to high interest rates over the longer term? And I think that's the thing that for me is keeping me up at night, is to think about, okay, well, if they keep interest rates here, at what point does the economy start to slip, and how bad of a slip does it happen, right? Because, they were talking transitory, and then it was the opposite. So now they're talking soft landing or minor recession. Do we actually end up getting a big recession or a depression?
Does the Fed ultimately need to cause a major contraction in the economy and higher unemployment to bring that inflation back down to their 2% target? And do you think that they'll have the political capital and wherewithal to be able to achieve that effect?
So I think that in their mind, they're hoping that they just have to cause a minor recession or some sort of, happy medium in there. My biggest fear is that there are so many, it's kind of a house of cards that they've built, right? Everything is reliant on Fed stimulus, free money, government spending, all of these factors. And that once you start jacking up rates and you keep rates high for a certain amount of time, what types of things could break in the system? And again, going back to like 2007, going into the 08-09 Great Recession, we know that the derivatives market just started to collapse, and it was really uncontrollable at that point. And that's kind of my biggest fear, is that it's the unintended consequences of what they're doing that ultimately could lead to a bigger collapse. And I am calling for a long-term recession. So I think that we're going to get in a scenario where the economy does slip into recession. It probably won't be Great Depression-like, but the Fed will be reluctant to lower interest rates quickly because of what happened to Paul Volcker in the 80s. Mm-hmm. And therefore, you're going to have an economy that doesn't know how to get back on its feet without low interest rates, without government spending, and without stimulus. And therefore, we're going to be stuck in this long, protracted kind of recession, probably 2 to 3 years it could be. The markets and the economy and even individuals, right? I mean, we've always been so used to, ever since 09, and even before that, you could argue that the Fed has always come to the rescue. But I think really since 09, when they started quantitative easing, where they actually were printing money and flooding the economy, you've seen the equity markets really responsive to that, all of these things going on. And that really creates a scenario where the market and investors are so reliant. It's almost like a drug addict and their drug dealer, where we become very reliant on that stimulus. And so once you take it away, right now there's still like that high, like, okay, maybe they'll come back in. Once the market realizes they're not coming to the rescue, I think that's where all out panic starts. And again, the economy, think about this. When people talk about a recovery, like, okay, let's say we slip into a recession, where does it come in where the economy does it naturally? How does the economy naturally get out of a recession? We don't know how to do that anymore. It's all reliant on, whenever the Fed prints money, that's when we'll get out of the recession. That's a horrible place to be. I mean, we are reliant on this one entity to get us out of this recession.
Do you think that we've seen these lag effects from the rate hikes start to have its effect on the markets?
Yeah, I do think so. I think the jobs number this Friday is going to be very important, whether or not that starts to show the weakness. But if you look at the metrics within the underground economy, so for instance, credit card debt is skyrocketing. I think it's even higher than it was pre-COVID. If you look at car loan defaults are starting to skyrocket as well. And so while the jobs market still seems to be holding its own, it to me is just on the precipice of a bigger collapse that we're going to start to see in the second half of this year. And I do think by the second half of 2023, we will say, you'll start hearing the metrics that we are in a recession. The key is the Fed's going to kind of say, it's going to be a shallow recession, while I actually think it'll be a long drawn out recession.
Are those just serious indicators of going into that recession that you're talking about?
I do think so, right? I mean, we had the emergence out of COVID where people had saved up money, they actually paid down debt, and then they went crazy and they started spending. And the spending, again, hasn't really stalled that much yet. So people get very addicted to living a certain way. It's hard to cut back spending when you get used to a certain lifestyle. So I think that's what's going on, and they're starting to run up that debt. They're starting to have to make the decisions. Okay, do we have 3 cars. Do we pay the loans on all these cars, or maybe we just focus on one car if we can't pay the other ones? I mean, what are the bills that start to go by? These pay as you go type purchase things like Affirm and other companies where you can buy something and pay a monthly amount with an interest. Those are companies that are now starting to get some trouble because people are saying, you know what? What if I don't pay for this TV that I bought? Is it that big of a deal? I need to pay my cell phone. I need to pay my rent. But what are the bills that I can say, okay, I don't have to pay these? And I think that's the beginnings of what's coming, the beginning signals of a recession that is coming.
Do we get, how does that affect the rest of the world? Are there countries that are somewhat isolated from that, or does it become a kind of worldwide phenomenon?
I mean, I do think it bleeds over into most of the world. There's obviously going to be countries that aren't as influenced by the consumer spending of the U.S., but I do think like China, for instance, while they will be influenced because we're not buying as many goods, they didn't see the inflation that we saw. So they're able to stimulate a little bit more, and they're going through a pretty bad real estate period right now as well. But I think, again, they can insulate themselves because they haven't seen that same sort of inflation that the Western world has seen. So I do think that there's areas to invest. I also think that any country that has a lot of minerals or metals in the ground, that's going to be an interesting play as well. Their economies probably do a lot better. South America, for instance, is a very interesting economy to me to start investing in or shying away from US, as well as China. I think China also is an interesting economy in the next 12 to 18 months.
Mm-hmm. Is it possible that now that China is opening back up, that they start to see some of the inflation that they might have staved off by being locked down for so long?
I think that is a good assessment. I do think that is a possibility. I think, it's a twofold thing. You're going to have a surge in demand after the lockdowns kind of end, which is what we're seeing in China already, which is inflationary. But at least a lot of the goods that they consume, you didn't see the same sort of inflation yet. And again, that'll be something that we have to watch. Are they a lagging indicator? Do they ultimately have that inflation surge later on and have to deal with it the same way as the rest of the world has? I think that for the most part, you have to look at it and say, okay, there's a tendency for China to, obviously China is one of the biggest consumers of copper, right? They're the biggest buyers of copper. So with them reopening, you have to anticipate that you'll see a pretty big pop in the copper demand. So even offsetting what the rest of the world may be contracting on. So I do think copper can stay, at least in the near term, relatively strong, maybe even show some additional upside. But I do think that we still have to watch those inflation numbers coming out of China, because if China starts to see that pop in inflation and has to then clamp down on their economy, you could also see that pull back later on. But I do think those industrial metals are worth keeping an eye on. Silver's another one that's kind of tricky, right? Because the rest of the world with batteries and so forth, you see silver really being an industrial metal plus a store of safety. But at the same time, does China help offset that with their demand? And again, it's a tricky market right now when you're dealing with that. Like gold is a very pure play, right? But the other metals are a little trickier because of the economic slowdowns and expansions in different countries. Gold, again, is one of those where, you have to look at it and say, okay, if the Fed really causes a tailspin in the economy to get inflation underneath 2%, then gold is still attractive because it's a fear trade. When people fear the economy, then they fear being in stocks, they rotate to gold. If the Fed says, hey, listen, we got to start cutting interest rates, we got to kind of do all that, well, then gold's an awesome investment as well. So I'm still in the camp that in terms of risk versus reward, gold is still the place to be for safety. Whether or not it's going to be the best performer this year between the S&P and the Bitcoin chart, I still am in that camp, but so far it hasn't been that way this year. So with gold, it's interesting, right? Because it seems like gold performs really well when the market anticipates a pause in rates or a lower rate. Right now, for instance, today we're seeing a drop in gold because Jerome Powell, before his testimony in front of Congress, he came out and was very, very hawkish, maybe insinuating even a higher interest rate needs to come into play. So I think right now, as soon as the Fed goes to the sidelines and even stops hiking, that's where gold will take off. Right now, though, again, we have to watch for that to be the next next catalyst. But I do think that gold, again, tests the 2070 highs from I think it was 2021, and even going back to 2019 or so. Those highs should get tested this year.
Thinking about, some type of another black swan or geopolitical tensions escalating a little bit more, that acts as a boon for the metals as well, right?
Absolutely. I mean, again, the initial response might be panic and fear, which causes the quick dip. And we saw it in COVID, and then gold just roared out of that at that period. So yes, absolutely. Any sort of fear, uncertainty, where you don't know what the economy is going to do, where earnings may be declining, I think that's the catalyst. And that's part of the catalyst for my bull case for gold over the next couple of years, is where if we get in an environment where we're in a recession, and that means an earnings recession, and earnings growth starts to subside and go negative, well, the question is, well, where do you invest your money, right? If the economy's in this long period of negativity, the only option, or one of the only options, is going to be that gold trade. And I actually do think that you'll look at like the GDX, miners, all of these as being the big bull players for the next couple years.
Do you see a sharper downside coming for the S&P here?
Yeah, absolutely. So right now what we have, and I think this is a really important chart of the S&P to zoom out to when we were at the all-time highs back in December of 2021, because what we saw basically one leg lower, two legs lower, and then three legs lower. And from that third leg lower, even though we've rallied off the lows, you can see it's kind of a bear flag development, or a bear wedge pattern. And so my expectation is that we're going to start to break below this upsloping trend line here. And once that happens, you'll have a few stopping points along the way. But my guess is within about 6 weeks, we're back to the I should say the February 2020 highs, which were the pre-COVID highs just before this dip in COVID. So again, for me, This is a period of consolidation. It's also a period of hope, which is kind of a sad thing to say, but we've seen stocks like GameStop and AMC and Bed Bath Beyond, and crypto's really caught a bid. People have been trying to relive the glory days of 2021, and unfortunately, the difference is you have interest rates where they are. You don't have the government sending checks to Americans. You don't have quantitative easing, so it's way different. But there's this tendency for human psychology to really want to revisit those good old days, and I think that's what's been keeping the market up. You've seen buy the dip come back in the stock market as well. And I think at some point, we're going to see a breakdown of that. To me, if you look at this chart, we're still making lower highs. And I think institutions are playing the smart game here and unloading into that small investor buying. And that's never a good thing. That means lower lows are coming. That
obviously comes into play in a big way here, probably within the next year or two, right? Like, what is your timeline on that?
Yes, and then that's going to be the next big hurdle, right? I mean, so this is the crazy thing, is that whether it's intended consequences or unintended consequences of higher rates. I mean, think about the debt, right? When we're talking about how much interest alone on the United States debt is going to be, of every dollar in taxes that I pay or you pay or anyone pays, how much of that is going to just pay interest on the debt when the interest rates have gone up this much? And then you talk about corporate debt. Corporate debt is relatively high, and all these companies are going to have to refinance at these higher levels. It's going to drag down earnings immensely. And then you talk about the impact on, all the layoffs. I think just again, I heard that Meta's laying off again. I mean, every day companies, these mega cap companies are laying off, and that eventually will filter through the entire economy, where you have less consumer spending. So it basically all is like so many like tentacles, but it all goes back to the fact that the economy will take a dump, eventually sliding into a recession.
Mm-hmm. So then let's look at the gold chart if we could, Gareth.
Mm-hmm. Absolutely. So here's your gold chart, and you can see today a nasty down day on gold, because again, Jerome Powell basically came out and said, hey, maybe a 50 basis point hike is going to be warranted. I think we have to wait till Friday's jobs number to know for sure. If the jobs number is strong, then yes, it does look like a 50 basis point hike is coming. But I still think that, again, this is a short-term thing. Even if they hike 50 basis points, you're going to have over the next couple months some weaker data, and maybe even weaker jobs data, that's going to push the Fed back to basically neutral, meaning they're not hiking anymore. And that's going to be the bull case for gold. So we've had this big move off the lows of November in gold. It's now having a retrace, which is very, very normal. For me, I think generally this 1800 level remains very, very strong. And I would expect a move up that takes out this trend line at around 1945 and eventually blasts off to this double top up here around 2070.
Of course, a big side of your business, and something we've seen a bit more volatility in recently, is Bitcoin. You've made some big calls on the Bitcoin chart, calling for 10,000. do you still see that setup?
Yeah, I do see it. And speaking of trading 24/7, the crypto markets do enable you to do that. So I've really done my best, but I'm not going to lie to people. Occasionally, I wake up at 3 a.m. and I'll pop up and just to see what the Bitcoin chart's doing. Luckily, crypto is very light volume in the overnight usually. But the bottom line is what we've seen is a very similar top pattern here on Bitcoin that mimics what we saw when we were in 2021. And I think this is something that people are missing. If we zoom out on the chart, look at this pattern. This up move, down move, up move where it made a higher high, and then the bigger breakdown. And if we go to this, it's almost like a mini formation of much the same pattern. And so for me, this is just a bear market rally. I still think there's lots of downside on crypto. Eventually, it's, in fact, you're making a bear flag right here, classic bear flag formation. Target near term, 18,000 and change, kind of 18.2 or so. But ultimately, I still think that there's more downside, and we'll go to 12 to 13,000 and eventually 9,000. And the kicker for this is not necessarily regulation. I actually think regulation, whenever it debuts, will be a positive thing for crypto. I think for me, it's more the equity markets and the risk off. So when we start seeing, and imagine we do go into a recession and the stock market drops 25% more. The question is, Bitcoin's trading at 22,200 right now. When we drop 25% on the S&P from the all-time highs, Bitcoin dropped from 69,000 to 15,000. So where's it going to go if we lose 25% in the stock market again? And that's where that lower target comes in, where I do think that we do probably see, 12, 13, maybe even 9.